on not-for-profit organizations. The not-for-profit community is very important to us, and we truly appreciate the opportunity to be affiliated with so many not-for-profit organizations in and around Central Virginia. Whether it is through volunteerism, providing our professional services, or financial support, your mission is important to us. Thanks for all that you do for our community. Today's webinar is planned for approximately 2 hours, during which there will be 8 polling questions. In order to qualify for the CPE credit, an attendee must respond to 6 of these 8 polling questions. CPE certificates will be available within 2 business weeks and will be sent via Eventbrite. Lastly, we welcome questions, and if you have one, please use the question and answer feature in Zoom. Now let's take a look at our agenda for the first half of the presentation. Colin Hannafin is going to lead us off with the more technical topics before passing it back to me for the fraud awareness topic. And Amy Menifee will wrap us up with the section on lessons learned. The second half of our presentation will be tax focused and presented by Carrie Jolly and Jenny Belcher. Without any further delay, Colin, I'm going to turn the presentation over to you.
Thank you, Richard. So during this first half of the presentation, we'll be touching on GAAP during the pandemic, touching lightly on revenue recognition and the new lease standard before talking about reference rate reform and the new gift in kind standard that was just released. So with that, probably the biggest focus of this year, or the biggest impact, of course, has been the COVID-19 pandemic, the biggest event that's impacted everybody's operations and organizations. And so I wanted to take some time here to talk about the impact of the pandemic on financial accounting and reporting. And some things to note is that, we will be talking about changes and new guidance that was issued in response to the COVID-19 pandemic, but also just some reminders of existing guidance that may be more applicable this year than perhaps in prior years. And the first item I wanted to touch on is the Paycheck Protection Program, the PPP, and the loans that were issued thereunder. And we have seen a lot of questions. The PPP was part of the CARES Act, which was signed into law in March 2020. And the application for loans opened soon thereafter. And we know a lot of organizations and entities received PPP loans in April and May. And now, as we get closer to the end of 2020, several organizations are starting to wonder, how should we account for these? This is something FASB has discussed, and they have determined that no additional guidance is necessary, that existing guidance provides sufficient support on how these should be recorded. Thankfully, the AICPA in June 2020 issued a technical Q&A. It's non-authoritative guidance, but it is helpful to try and determine how to account for these PPP loans. And really, there are 2 options. The first is that you can account for the PPP as a loan. This is the more conservative option, and you would maintain it as a liability until it is either repaid or forgiven, or some combination thereof. One thing I want to note here is there's no need to impute additional interest. These were issued with 1% interest, but because that is governmentally prescribed, you don't need to impute what market rate interest would be. Nonprofits, thankfully, have it a little bit simpler because the alternative is to account for the PPP loan as a grant, and you would record it as a conditional contribution that you will record as a contribution when the conditions are substantially met or explicitly waived by the forgiveness. And in this case, the conditions are to spend the funding in accordance with the program. So what is the correct way to use it for you and your organization may vary. We have seen some variety in practice. And so this is a thing you want to be focused on going into the 12/31 year end, or as you're looking forward to June 30 reporting, what is the proper way to report this? And of course, any reporting on the face of the financials should be supported with disclosures in the notes to the financial statements. It is a little more complex for for-profit entities, many of whom will actually be sort of borrowing the not-for-profit guidance for counting them as contributions. Moving forward, I wanted to talk briefly on going concern. There was a new standard issued 6 years ago in 2014, and it's been effective for all entities for several years now. And I just wanted to remind everybody that with this standard, management has to make an assertion regarding the entity's ability to continue as a going concern that auditors will now assess. And the change in that is used to be something the auditors would assess without an assertion from management. And so now management is required to look at projections, look at cash flow, future expected cash flows, and determine is there any concern about continuing as a going concern. And this also changed how far ahead you have to look. It is 1 year from the date the financial statements are issued, not the date of the balance sheet. So this is likely to receive more scrutiny in 2020 and 2021 because of the current economic environment. So I wanted to make sure everybody was familiar with that. We also wanted to touch on debt modification and extinguishment. I will say FASB, at least as it pertains to borrowers, has not released any additional guidance, but we wanted to include this as a reminder. We believe we'll see this a lot more in 2020 and 2021. A lot because of the COVID-19 pandemic. A lot of debt agreements were modified, or perhaps concessions were granted in terms of repayment or the timing of repayment of debt. And in order to determine whether a change in your debt agreement is a modification or an extinguishment, you look at the future cash flows. Thankfully, there is a bright line test. You look at the present value of future cash flows under the new debt or the modified debt and the old debt, and you see how different they are. And if there's at least a 10% difference, then you have an extinguishment. If there's not, you just have a modification and you apply those changes prospectively. One thing I do want to note is that FASB did issue guidance for creditors about when troubled debt restructuring guidance applies for modifications of debt issued. And basically, short-term modifications made in good faith to borrowers who are experiencing operational or financial problems as a result of the pandemic won't automatically be considered troubled debt restructuring if the borrower was current on making payments before the modification. And so this will apply to payment deferrals, extension of repayment terms, things like that. And that is for creditors, for the lenders. Next, I wanted to touch on another type of modification I think is likely to be prevalent throughout 2020 and beyond, and that is lease modifications. And FASB has acknowledged that there is lease modification guidance in existing lease guidance, ASC 840, and the new lease guidance, ASC 842, but it did not contemplate the concessions on the scale seen during the pandemic. Nobody expected something like this, and the guidance wasn't designed to handle that. And so in April, FASB released a Q&A, a technical Q&A on lease concessions that said, essentially, entities can proceed as though the rights and obligations for the concessions already existed within the lease contract, as though the lease contract were written contemplating a high number of lease concessions. And in that way, you don't necessarily have to consider, if you proceed as though those rights and obligations already existed, you don't have to consider the lease modification guidance under ASC 840 or 842, depending on whether or not you've adopted the new standard for all of those concessions that happened. And so entities can elect to apply or not apply the lease modification guidance in 840 or 842 for all of the COVID-19 related concessions. Essentially, it provides for two options for the deferral of payments. You can either count for the concessions as though no changes were made, in which case you continue recording expense and you just build up accrued rent, or you can account for the deferred payments as variable lease payments and apply those changes prospectively. Finally, when it comes to accounting and financial reporting as a result of the COVID-19 pandemic, wanted to touch on a couple of other items that have received increased discussion throughout the COVID-19 pandemic and throughout 2020. And that is, first of all, non-GAAP measures. A lot of management groups have elected to start focusing on some non-GAAP measures in their communications with various entities because they may provide a more favorable outlook, or they may do a better job of representing the economic realities in a way that GAAP does not. And so this could be things like EBITDA, or it could be you take a regular GAAP measure that existed during 2020 and you adjust it for the impact of the pandemic to sort of normalize it. And one thing you should note is that when these are being used, you should communicate, why does management prefer these measures? Why do they think it tells a better economic story? And while these may not appear in GAAP financial statements, this may be something in additional reporting that is provided to lenders or donors or something along those lines. You want to make sure they understand why you're presenting the information in this way. Also, liquidity disclosures, which were required under the new not-for-profit accounting guidance a couple of years ago. The one thing I want to note here, obviously those may look very different for 2020 year ends, either June 30th or 12/31, than they have in the past. But this is really an opportunity for organizations to share their story and give readers some insight into how management manages its liquidity. And so just see that as an opportunity to tell the organization's story a little bit and how it is navigating the pandemic. The last couple items on here, impairment considerations. The first thing is that goodwill that is recorded for subsidiaries or other intangible assets may have to be evaluated for impairment tests depending on the impact of COVID-19. And this is likely to be a focus of audits of periods that include the impact of the COVID-19 pandemic. Because there's been such economic upheaval, there's going to be a lot of focus on items like intangible assets or other things held at fair value to try to determine whether the impact of the pandemic is appropriately represented in those figures. Finally, the last thing I wanted to note is loss contingencies. And just as a reminder, that loss contingencies should be recorded in the financial statements if they are probable and reasonably estimable. And so probable losses that can't be estimated, but you think they will occur, those should be disclosed in notes to the financial statements. And so that's something to consider, especially in conjunction with subsequent event considerations. Obviously, there's been a lot of, as I've mentioned, economic upheaval, but also significant changes to lease agreements and to debt agreements, and all of these things that may change the organization's economic outlook. So something to keep in mind when you're going through your year-end guidance. With that, we will launch into our first polling question. How has the COVID-19 pandemic impacted your organization? Claire, could you go ahead and, it's already launched. And so there you can see the options of very negatively, somewhat negatively, little impact, or positively. So please take a moment, and the responses here are for, or these polls, of course, are for to verify your attendance and participation. while we may look at the answers, we won't be looking at individual answers or anything like that. So please feel free to share your experiences. We'll give everybody just a minute. As Richard mentioned, this is the first of 8 polling questions that you will need to respond to in order to receive CPE. All right, and we're right at about 94%. Claire, could we go ahead and shut that down and show the results? And so, okay, so we see many of the attendees today have been impacted somewhat negatively. A couple have been impacted very negatively, and a lucky few were actually impacted positively. So that's certainly good. We obviously hope to see all of our attendees weather this pandemic and come out stronger on the other side, as difficult as that may be. So you can go ahead and close that poll, Claire. And we will move on to revenue recognition. One of everybody's favorite topics. It's been a topic of discussion for 6 or 7 years now. And I'll just touch on it lightly. Most of you have, I'm sure, already heard of the new revenue recognition guidance. As a reminder, it replaces substantially all existing revenue guidance with a 5-step recognition model, under which you will identify the contract with the customer, identify any performance obligations, determine the transaction price, allocate the price to the performance obligations, and recognize revenue when or as performance obligations are satisfied. I won't go over those in any detail. The one thing I want to note here is that it does not apply to contributions, which will still be recorded under existing existing not-for-profit guidance, but it does apply to exchange transactions. The other thing I want to make sure I note is that for those of you who have already implemented this, you may be able to share that there have been significant challenges to implementation. It takes a lot of time, effort, and energy to understand the potential impact on any organization. And so it's something that warrants your attention if you have not adopted it yet. ASU 2018-08, which was issued a couple years ago, helped provide some clarity over the differences between exchange transactions or contributions to try to make that a little bit easier for not-for-profit organizations. And it's already applicable for all recipient of donations or contributions, and it's applicable for resource providers in the next year end, either December 2020 or June 21. And essentially it asks, does the resource provider benefit, in which case it's an exchange transaction, or does the general public benefit, in which case it's a contribution? FASB considered delaying ASU 2018-08, and they determined not to. So I know a lot of organizations have already adopted this, and that is to help make it easier to determine whether something should fall under existing not-for-profit guidance or the new ASC 606. Now, 606, this June, FASB did delay the implementation of ASU 606, and the intent was to provide relief for those accounting departments that were negatively impacted by the pandemic because of the time and effort that it takes to determine what the impact of implementation is. So even if management does not believe there's going to be an impact, there still has to be an assessment and documentation of that assessment to support that assertion. And so what we have seen in practice is a memorandum for different types of contracts, walking through that 5-step process that was on the previous slide and showing how they apply. And so there's a lot that goes into that. And I just want to make sure if your organization elected not to adopt this for for December 19 or June 2020 year ends, this is something to look at, to have on your radar, because it will be applicable in the very near future, and you want to start that process of determining the effects. Next, I'm going to jump into the other big new standard that we have been talking about for several years now, and that is lease guidance, the new lease standard. Under the new lease standard, ASC 842, which was issued back in February of 2016, for lessees, all leases greater than 12 months will now be represented on the balance sheet or statement of financial position. And the focus here on this portion will be on the lessees because those are more widely applicable. And for lessors, there were relatively few changes. Some of the words changed. They change how they referred to things, but the actual guidance hasn't changed significantly for lessors. This will apply to virtually all leases with some minor exceptions. And there are two types of leases, finance and operating, under the new guidance. Those are very similar to existing leases, operating or capital, and the classification considerations are pretty much the same, with the exception of a new one that says if the underlying asset is so specialized that it is expected to have no alternative use to the lessor, it's a finance lease. So you've seen this several times, likely at this point. I don't want to talk about leases for too long, but I do want to hit on a couple of high notes. Number one, this is just a high-level accounting overview, and you can see the impact a finance lease or operating lease will have on the statement of financial position, statement of activities, and the cash flow statement. Finance lease will be treated substantially similarly to a capital lease currently. The one thing I do want to note on the slide is the very bottom bullet. The initial measurement occurs at the commencement date. So if a lease has been agreed to, but it has not yet commenced, there won't be anything to record at that point. Initial measurement might be the trickiest part of the new lease guidance, and it's a substantial part of adopting the new lease guidance. And so I wanted to take just a minute. It really hinges on determining the value of that lease liability. And so the first thing, it sounds relatively simple. It's just the present value of future unpaid lease payments. And so when you're considering the inclusion of future option periods, such as renewals or early terminations, the option must be reasonably certain to be exercised. That is a slight change from existing lease guidance. And when they say reasonably certain, they mean that the organization has economic incentive. So there has to be a reason the organization will exercise the option. That could be contract-based, perhaps the rental rates are below market, or asset-based, such as leasehold improvements that would have significant value and would cost the organization to set a significant amount to set up a new office or space, and a couple of others such as market-based or entity-based. So this is just, it turns it from, it makes it a little more clear whether or not option periods should be included. The other big factor in determining the initial lease liability is how to calculate that present value, what discount rate to use. And there are three options. The first is the rate implicit in the lease, and lessors must use this option. The second is the incremental borrowing rate, and the third is the risk-free discount rate, which is only available for non-public entities and must be elected for all leases. The one thing I want to note here is calculating the incremental borrowing rate for those who the lease guidance is already applicable for public entities. Some may have already adopted this. Based on the guidance and the reactions that we've seen, it is pretty difficult to calculate the incremental borrowing rate. You have to look at it for a similar borrowing amount over a similar period, over a similar term, and so it can be difficult to calculate. So many people non-public entities default to the risk-free rate, which tends to be lower and have a higher impact. It's a lot easier to calculate though. In June, FASB did delay the implementation of the lease standard by an additional year. For public entities, it was applicable in 2018. For public not-for-profits, meaning any not-for-profit that has issued or is an obligor for conduit bonds for that are underneath securities traded, listed, or quoted on an exchange or over-the-counter market. For everybody else, it won't be applicable until fiscal years beginning after December 15th, 21. So it's still a couple years away. But like revenue recognition, this will take a substantial amount of time, effort, and energy to implement. So we want to make sure that management is thinking about this now. The last slide on this topic is really FASB has proposed a couple of new minor improvements. The comment period is open through December 4th, but really what I want to highlight on this slide is that FASB does go through a post-implementation review to try to ascertain what went well, what could have gone better, and perhaps most importantly to this, to our attendees, is what improvements can be made before it is effective for everybody else. So just this week, a lot of large CPA firms have reached out to FASB asking for more guidance or amendments or further education to eliminate differences that they are seeing in practice in the implementation of the lease standard. So more things to come on this perhaps, and we will of course keep you updated on that. Now we will launch into our second polling question, which is how prepared are you for the new lease standard? If you could go ahead and launch that, Claire. Have you already adopted it? Are you working on the transition? You've had some high-level discussions, but haven't gotten into the weeds yet, or you haven't given it a second thought yet. There have just been more pressing matters to take care of, which we certainly understand. But for those that have adopted it, you may be able to say just how challenging it was to adopt, and it's definitely worth your time and attention now. We'll give just a minute for this. We're right at 93% now. So Claire, if you could go ahead and close this one out and share the results, we'll see. Haven't given it a second thought, a slim leader. We can see that a few people have already adopted it. Again, completely understand. It's still a couple years away, but something to start giving a second thought. Now would be a pretty good time. We can go ahead and close that out. And of course, that is something that will be, we expect to see a lot of work done for adopting that new standard in the next couple of years. Finally, just a couple of quick last things to touch on. The first is reference rate reform. As many of you know, LIBOR is going away after December 2021. The Alternative Rate Reference Committee, which is part of the Fed, the Federal Reserve, is continuing to work on the transition to SOFR, which is the secured overnight financing rate. They're still working on putting the infrastructure in place. Just in October, the Alternative Rate Reference Committee put out an RFP to find a vendor to publish and track those SOFR rates. In March 2020, FASB issued some new guidance, optional guidance, to make the transition a little bit easier. But this is something that is coming down the pipeline. Just earlier this week, U.S. banking agencies issued a joint statement urging banks to stop using LIBOR as soon as practicable. So this is happening. If you have assets or debt that is tied to the LIBOR rate, most of the banks will be handling this, but it may be worth starting a conversation with your banker. Finally, I wanted to touch on ASU 2020-07 about gifts in kind. This was issued this September, and it doesn't change any of the underlying accounting in regards to recognizing gifts in kind or contributions of non-financial assets. What it says is it's intending to increase the transparency of disclosures of gifts in kind, and this applies to both goods and services. So under the new standard, contributions of gifts in kind will be disclosed as a separate line item on the statement of activities, and in the footnotes, an entity will have to disaggregate gifts in kind by category. This will be effective for fiscal periods beginning after June 15th, 2021. And so that's something to be on the lookout for. This is coming down the pipeline. The additional disclosures that will be in the footnotes. So for each, as I said, you will have to disaggregate gifts in kind by category, and then for each category, you will have to disclose whether the gifts in kind were monetized or utilized during the period, what the organization's policy is about monetizing or utilizing those gifts, a description of any restrictions, a description of the valuation techniques to calculate the fair value, and the principal market used to calculate that fair value if the organization can't access, cannot sell or utilize the gift. And here, I won't spend too much time on it, but we have some disclosure examples. So this might be what the table looks like in the footnotes of the various gifts in kind. That total at the bottom, the 1.2 million for 2022, that would tie back to the statement of activities. And you can see that also services are included here as well. And there would be some additional language with the footnote. This is just a piece of what that language may look like. And you can see here at the bottom of the first paragraph, it mentions, unless otherwise noted, contributed non-financial assets did not have donor-imposed restrictions. So that is one of those elements that is now required. You'll see the policy in the start of the second paragraph, the policy to sell all contributed vehicles immediately upon receipt. Again, disclosing that policy and making it clear what is going to be done with those assets. And under contributed building, you can see it states what it will be used for. And at the bottom of that paragraph, what the basis of that fair value is. We do have more of this example on our blog, so please feel free to check it out at keitercpa.com. And hopefully that is helpful as you look towards adopting this in the coming year. And now I will turn it back over to Richard to talk about fraud awareness during the pandemic.
Okay, thank you, Colin. Good morning again, everyone. As you can see on your screen, we're now going to shift gears a little bit and start some discussions just around what we're seeing, what we're hearing with COVID-19. And one of the things that concerns us is just the potential for fraud in the current environment. If you've sat through fraud presentations in the past, you may have seen this quote, at any given moment, there is a certain percentage of the population that's up to no good. So, during uncertain economic times, which is what we're currently in, it's not unusual for that percentage to increase. So again, if you're familiar with the fraud triangle, which if you sat through many fraud presentations, this has to be discussed at some point. So I'm going to kind of start off with it at the beginning. But if you're familiar with it, you're aware that there are always three elements present when a fraud is perpetrated. So those three elements are the opportunity, a rationalization, and some type of pressure. So when you think about the past 6-8 months, pretty much since mid-March, we have seen a large number of layoffs and other types of disruptions to the economy. And those can lead to a couple of things in not-for-profit organizations or really any business. the employees that are fortunate enough to be retained at times are asked to take on more responsibility, more duties. So they have more on their plate, kind of filling in for some of the holes that need to be filled due to less staff. Employees that may have been retained in their job may have some sort of family situation where they have been negatively impacted. So they've been fortunate enough to keep their job, but maybe a family member has not been as fortunate. There could be a potential illness, especially with us dealing with a pandemic that has resulted in some additional medical expenses, whatever the case may be there. Fewer employees through layoffs involved in those employees could have been involved in important processes. So you have fewer employees now, so the segregation of duties that's so important are no longer there. And then, what we've all, I think, pretty much can uniformly say is working from home. Pretty much every client I spoke with, they were working from home for a significant period of time. So that remote work environment, there's less direct supervision, internal controls that were working very well potentially in the office environment had to very quickly be adapted, and something could have potentially been missed as people went from in office to at home working. So all those situations can lead to fraudulent activity. And so we need to be more aware than ever and be on our toes and be looking out for anything that could cause concerns from a fraud perspective. Okay, so if you've had a chance to read through this statement here, this statement is true in the best of times. Nonprofits need to use their resources as much as they can to facilitate their mission and deliver programs. So the back office functions sometimes can be leaner. Oftentimes that's by design. Again, you want to make sure that you're putting as much of your resources as possible into programming. And that's what donors and other stakeholders expect. However, it does create some risk and increased vulnerabilities in the organization to fraud or to error as well, which is something that can cause problems. Oops. Okay. So every 2 years, the Association of Certified Fraud Examiners publishes a report to the nations on occupational fraud and abuse. And so they rely on their members to submit fraud cases that they've been involved in, and they collect all that data, put it all together, and produce this report, which has just a lot of really good information on where fraud, where they're seeing it, how big it is, how it's being perpetrated, how it's caught, so forth and so on. And so the report covers all types of businesses, but there is a section that is specific to not-for-profits. And so that's what we're going to dig into a little bit more. So as you can see on this slide, in the 2020 report, there were 191 nonprofit cases reported to be included in this report. And the median loss was about 75,000, and the average loss was 639,000. So obviously very significant numbers to definitely the nonprofits that we work with here at Keiter. The top 3 control weaknesses, or those items that resulted in the top, the frauds, were a lack of internal controls. So just controls did not exist. A lack of management review, which is an element of internal control and one that's relied on quite a bit in smaller nonprofits because you're not always able to segregate duties in an ideal way. So you need those reviews by management, by the board, and you need those reviews to be effective as well. So that was kind of the second one there. And then an override of existing internal controls. So again, controls are in place, however, they're not being monitored sufficiently, and they are, being circumvented in some manner to perpetrate a fraud. And then in the report, these are kind of the top 5 means of detecting frauds in nonprofits. And so the tip or complaint, whether it be, tip line or whatever the case may be, was 40%. Internal audit, which I think maybe only a very small handful of our clients are fortunate enough to have an internal audit function. So for us, I mean, that really can't be, doesn't even really come into play. Management review, so there where you had management review and it was effective, was 13%. Of course, by accident, someone just kind of stumbled upon it. And then examination of documents, which probably isn't all that different than management review. So, and another thing that I probably should have pointed out a little bit earlier is those 191 cases and all the information that came that was used to produce this report occurred before the pandemic, because this was published around April of 2020. So again, all this information is pre-pandemic. So now one additional piece that I wanted to share that is not in the slides is that the asset misappropriation is by far the most common fraud in nonprofits. And there are a large number of schemes that fall under asset misappropriation. So just some examples: theft of cash, which can happen in many different ways, but skimming is certainly one. Just outright theft is a second. And then fraudulent disbursements. So this can include just normal disbursements as well as payroll. So different types of billing schemes, payroll schemes, whether it be a ghost employee or falsified wages, or somehow taking advantage of the benefit side of payroll, whether that be putting a little extra in a retirement plan, or not, maybe not withholding the employee portion of some sort of benefit where there's a shared responsibility. Expense reimbursement schemes, especially credit cards. So that's one that is fairly common. Check and payment tampering. And then lastly, again, just any sort of, taking advantage of the disbursement process. So again, you can have a fictitious employee. You can also have a fictitious vendor. So definitely that's the most popular. That's the way, and you want to put your effort if you're trying to determine ways to address what could be fraud concerns. You want to put your efforts into those areas that are the most prevalent. Okay. So as I mentioned, and as we saw earlier, the lack of internal controls, the overriding of internal controls is the major problem. And so we have covered that, easily, in talking about fraud. We know that can cause those issues will cause fraud, but there's some other areas too that can come about by having a weaker internal control environment. So inaccurate financial and managerial reporting. So that can lead to error, or result in making bad decisions, because the information you're using to make decisions, whether it be yourself, whether it be your executive director, your board, whatever the case may be, using bad information can lead to bad decisions. So that's another side effect. Lost efficiency. So, a duplication of effort. And we've already talked about how resources are scarce when it comes to kind of running the back offices of nonprofits. So we certainly don't want to duplicate any sort of efforts. And so having that stronger internal control environment can help minimize that. And then failure to execute on your strategic or operational objectives. So again, that kind of falls under the lost efficiencies. On the compliance risk side, if you receive federal or state funding, and the term we use there is any sort of expenses that could be unallowed. If you don't have the proper controls in place, you can find yourself in a situation where this wasn't a fraud. It was, you weren't intentionally using these funds for means that they should not have been. So it was an unintentional act. However, if those funds are audited and you don't have, if you don't have the controls in place to make sure those expenses are only for allowable purposes, then you may have to fund those expenses out of your money versus being able to use the grant money. You could potentially have to return some of the grant funds. And then if you're in the nonprofit space, you're very aware of just the reputational risk and how important it is to protect your reputation at all times and really at all cost. That's paramount in our industry. So kind of circling back to fraud, and these are just the very basics, but just things that you need to try to do your best with the limited resources that you have to help curb fraud to the extent you can. Certainly segregating of duties. Oftentimes we see where maybe people that, if you have an accounting person or accounting department of one, you may have to pull someone that's not in accounting into part of the accounting process to help do some segregations. Just there, you need to be careful that the person is certainly engaged and receive some training so that they understand what's being asked of them and know how important what is being asked is to the organization as a whole. You want to make sure you're safeguarding any susceptible assets. So petty cash or check stock, anything like that. If you have inventory that has some value to employees or to the general public, you certainly want to safeguard that as well. So be thinking along those lines. Limiting check signers to a smaller group of people, and certainly not someone that has the ability to access the system and print checks is important. Monitoring wire transfers and limiting where those wire transfers can go. So, wire transfers only between selected accounts, making sure that there is an initiation feature and then kind of an authorization feature. So it takes two people to initiate or execute a wire transfer. Considering the use of positive pay. So this isn't necessarily, an internal fraud feature, but more so trying to protect against external fraud. So working with your bank to evaluate whether positive pay makes financial sense to your organization to protect, from those fraudsters that may be more active during this time period, especially with understanding the decentralized office environment and that sort of thing. And then limiting system access. So making sure that individuals that can access your accounting system can only access what they need to and don't have if they just need to have view-only access, that they don't have full access to the system and could actually go in there and, do something either accidentally or on purpose. But, having full access and being in a position to perpetrate fraud puts them in a better position to conceal the fraud, okay? And then lastly, and just kind of to wrap up, I've talked a couple of times about the new remote work environment that most organizations are still operating in to some degree. We believe there is a high likelihood, based on discussions we're having with clients, that some amount of remote working is going to continue into the future. So establishing oversight and internal controls is really important. That will work well both in the office and out of the office. But what we found is that, speaking with clients, that they found that they can work effectively from home or from remote locations. And so the processes that worked very well and were very well refined in the office, maybe for a period of time, took a complete backseat because everyone was just trying to navigate this new environment and then kind of work through that. And then in some of these discussions, and we, as you all may know, we do a lot of June 30 audits and have talked to a lot of clients. And while they may have had to spend some period of time, maybe not where they wanted to be, they were able to kind of quickly turn their attention to internal controls, but then making sure that they weren't just, putting Band-Aids in place, but putting in longer term processes and kind of thinking through how technology is going to be more of a factor in their operations moving forward, as employees have probably enjoyed some of the flexibility that they've been able to undertake by working from home. Okay, now I don't want to go through all these individually, but again, you all will have access to the slides, and just make sure that you're thinking about how you can implement any of these or any other controls to make sure working from home continues to be safe for your organization's assets. Okay. And now with that, we're going to launch what you'll see as our third polling question. So post COVID-19, how quickly do you anticipate returning to what we're calling, kind of the pre-pandemic office environment? Either immediately, gradually, never, or it's just too soon, unsure at this point. So we're going to give you about a minute to respond to that. Okay, hopefully those responses are coming in and we're getting close. Okay, yeah, so we're at about 95%. So if we want to take a look at the results. Okay, so gradually, so people, it sounds like people do plan to get back into the office, or at least the majority, a little over 50%, do plan to get back to the office for a full 5 days, but maybe just going to take it a little slow. So great, thank you for that. So at this time, I'm going to turn the presentation over to Amy to present the lessons learned during the pandemic.
All right, thanks, Richard. So here we have a quote to start us off. Times of crisis, of disruption, or constructive change are not only predictable, but desirable. They mean growth. Taking a new step, uttering a new word is what people fear most. So I wonder really how many of us feel that way, that disruption is desirable. My guess is probably not too many. So the real question is, what have we learned from the pandemic that can help us in case of another disruption? We'll go through 3 lessons learned, starting with cash is king. First line, cash is needed for survival. I think that's pretty obvious. If you have a line of credit, you should be frequently communicating with bankers, ensuring all your financial covenants are met, or if you know you're not going to meet them, then you should be seeking relief and having that conversation with your banker as soon as possible. Be aggressive as possible with collecting receivables in order to get money in the door. Negotiate longer terms with vendors to keep the money you have, and manage your accounts payable by prioritizing payments. You should also be containing costs, and obviously there are multiple ways to do that. Those could include curtailing non-essential spending, having a hiring freeze, staff reductions, not allowing overtime, or having an across-the-board percentage reduction in pay. In order to keep cash, only make capital investments to address life and safety issues. Communicate throughout the organization that preserving cash is a priority so that everybody's on the same page. Consider selling underused assets, and solicit in-kind goods and services to replace budgeted items. Also, the last item here, maintaining operating reserves. Couple things regarding that. That helps to maintain stability and continuity of operations during difficult and uncertain times, and it allows for a margin of error. It can enable organizations to pursue and self-fund opportunities of strategic importance even during uncertain times. And a common target for that is 3 to 6 months budget, but it definitely should at least be enough to cover one payroll. The next lesson learned is to know your revenue and expenses. So identify your reliable revenue and funding sources in case you need to tap into them. Safely provide billable services, which especially in the situation that we're in right now with the pandemic, that can be difficult because you obviously have to follow all the HR laws and make sure that your employees are safe at the same time. Position the organization to take advantage of unique funding opportunities, which can also be helped by having that operating reserve that we just mentioned. Forecast year-end numbers and ensure financial covenants will be met. As mentioned, if you're not going to meet them, talk to your banker. Incorporate into the budget process various scenarios and have trigger points and resulting action if those trigger points are reached. This is really critical to success in uncertain times. It allows the organization to identify potential threats and to develop contingency plans and risk mitigation strategies. And for organizations that really do incorporate undesirables into their budgeting and planning process, they're much less likely to have surprises. And then with all of this, consider the need to meet more frequently with the board or finance committee. And then today's last lesson learned is to plan for disruption, but strive for flexibility. So be ready to respond to worst case scenarios, but leave space to pursue new opportunities. And once again, if you have an operating reserve, you may have that space to be able to do that. Take advantage of the momentum for change, build in extra time, and then test, experiment, learn, and change. Look for ways to add flexibility to revenue streams. A couple of thoughts on that is potentially ask customers to donate program fees that aren't being paid. Talk to funders about repurposing restricted funding if it's not for the purpose you need. And then build on what works, but don't be afraid to let go of what doesn't work. Make sure that all core functions have been cross-trained and processes are documented. For example, know who has access to accounts and signature and approval authority. And use structure, including teams and committees, to keep work moving forward. Make sure you have good meeting, or you're using meeting best practices like agendas and good note taking. And then keep in mind people's attention spans. You know, you probably shouldn't have a 4-hour meeting because you're going to lose people halfway through. Avoid bottlenecks and have clear backups. And that goes back to know who has access to accounts and signature and approval authority. And so with that, our 3 lessons learned, we're going to go to polling question number 4. What has been the biggest lesson learned during COVID-19 pandemic for your organization? Okay, we got the answers coming in. Remember to make sure that you answer the polling questions in order to get your CPE credit. And we are at 93%. So we're going to go ahead and close that down and show the results. So biggest lesson learned during the COVID-19 pandemic, seems like plan for disruption is a pretty popular one. In fact, it is definitely by far the most popular. So hopefully our 3 lessons learned helps you in planning for whatever the next disruption might be. And with that, we can close that polling question. And we will move on to the second hour of the presentation.
Okay, thanks, Amy. This is Jenny Belcher, and I am going to talk about everybody's favorite, UBIT. Wait for Carrie to get the slides up.
I am, it looks here waiting. Okay. Thank you everyone for your patience.
While Carrie's doing that, I'm going to just
There
start.
you go, Jenny.
Okay, thanks. The IRS has issued 2 new draft forms that we're going to be using, not-for-profits are going to be using to report UBTI beginning in 2020. They've got a revised 990T and a new form Schedule A. And these reflect changes made to the proposed regs that were issued in April of 2020 that addressed how to calculate the UBTI separately for each trade or business. As you all remember, under TCJA, tax-exempt organizations could no longer offset income from one trade or business with a loss from another, but they had to start calculating each one separately and siloing this income. So we had these proposed regs that came out in April, and just last month on November 19th, the IRS issued an advanced version of the final regs. So the final regs generally have adopted the rules that were outlined in the proposed regs with some clarifications. So we're going to take a look at the new draft of the 990T, and then I'm going to kind of summarize some of the key points in the soon-to-be final regs. The 2020 draft form 990T is considerably shorter. It's just 2 pages. It doesn't include any of the schedules A through J that were part of the 2019 form. These schedules were things like cost of goods sold, rental income, unrelated debt financed income, advertising income. These schedules have been relabeled and now they're going to be moved to the new Schedule A. So the shortened version of the 990T has 5 parts. And the first part is just a summary of all your unrelated business taxable income. And this is all going to be computed from those Schedule A's that we're going to look at in a few minutes. Then it has a part 2, which is simply the tax computation. And then we have parts 3, 4, and 5. Part 3 is where we're going to list all your payments that you made, any credits that you received, estimated payments, to come down to whether or not you have a balance due or no overpayment. And then parts 4 and 5 contain some additional information that they're requesting, questions to be answered. And then in part 5, your supplemental information. This is where you can put any additional information that you need to provide relative to any question that you answered in part 4. We always have a supplemental information section. The new form Schedule A is now going to replace the Schedule M that we were filing on the 2019 992. And in the Schedule A, we're going to calculate all of your unrelated trade or business income. Part 2, we're going to take any deductions against that income. And then beyond that, we have Schedules 3 through 11, which were formerly the Schedules A through J on the 2019 return, and they've just been moved over to Schedule A and become a part of this. So for instance, if you have 3 different trades or businesses, you're going to complete 3 different Schedule A's, and then those are all going to be summarized and put back to the Form 990T. So the majority of the information and all the calculations that you're going to do for your UBIT is going to be moved to the Schedule A, and then the 990T, like I said, is going to be sort of a summary of all your Schedule A's that we use to calculate your liability. Another thing that came out in the regs with this is that beginning in 2020, all organizations are now going to be required to file the 990T electronically, which I think is a good thing because we've been filing the 990 electronically and unfortunately having to mail the 990T separately. So this is not really a bad thing at all. So another thing I wanted to talk about is kind of look at some of the key points in the regs that are soon to be coming out. And how do you identify your separate trade or business? And the regulations require that organizations identify its separate trades or businesses now using the first 2 digits of the North American Industry Classification System codes. That would most likely describe your unrelated trade or business. So you're going to look, if you have 3 or 4, you're going to look at each one, pick the code, the 2-digit code that best describes it. And they also say that you're only going to report these codes once. So if you've got on your 990T, so if you've got several trades or businesses that fall under the same code, you're going to be allowed to aggregate that income or losses from those businesses because they all fall under the same code. And then finally, they say you can only use you have to pick your code, and once you choose it, you can't change it. So once you file a 990T after the final regs come out and you've chosen a 2-digit code, you can't go back and change it. The only time you can change it, they say, is if you can prove that you picked the code that was due to an unintentional error, or that maybe another code may more accurately describe the unrelated trade or business. They haven't specified whether that's simply going to be a footnote or something that you're going to put on that 990T if you do need to change the code, or if there'd be some other way of getting in touch with the IRS as to fixing a code if one was unintentionally an unintentional error. The next part of the regs that are soon to be come out involves investment activities. A lot of not-for-profits are getting K1s from partnership investments. Some have S-Corp investments, things like that. And they throw off unrelated business taxable income, and they have to file a 990T. Well, the IRS has looked at this and said, you know, certain investment activities should be able to be aggregated. So we're not going to have a separate trade or business for each one. But these certain investment activities that can be aggregated would generally be limited to a qualified partnership interest, a qualified S-Corp interest, or debt finance properties. And for a partnership to be classified as a QPI, it has to meet one of 2 tests. It has to meet the de minimis test, which means that the tax-exempt organization holds no more than 2% profits interest and no more than a 2% capital interest, or it has to meet the control test, where the organization directly holds no more than 20% of the capital interest and does not have control over the partnership. So if it meets either one of those tests, then that partnership and that information off of that K1 can be treated as an investment activity and aggregated with other investment activities. And you can use your K1 to determine your percentage interest in the partnership, as long as it specifies a beginning and ending percentage and doesn't say like various. Qualifying S-Corp interests are the same way. They're generally treated as separate trades or businesses and always are UBIT. However, to ease the administrative burden, the IRS is saying we can aggregate the UBIT from the S-Corp with other UBIT from other investment activities, as long as the percentage ownership meets those same 2 tests, de minimis or control. So if you've got 3 or 4 partnership K1s that are all under 2% or less than 20% of control capital interest, and the same thing with your S-Corps, you can lump them all together as one trade or business, one UBIT. And the other activity that they say is investment activity is debt finance properties. The IRS agrees that debt finance properties are generally held for investment purposes. So you can include any income from a debt finance property as an investment activity and aggregate them with all the other investment activities. So they kind of have made it a little bit easier. You're going to have to look at your K1s to determine your percentage ownership or your percentage interest to determine if you can aggregate them all together if you have multiples. But at least we don't have to treat them as each as a separate trader business and have multiple Schedule A's. One thing in the regs that's coming out that they didn't address, they really haven't provided guidance on the proper method of allocating your expenses between your organization's core exempt activities and your unrelated trader business activities. The only thing they did say, they stated that using the unadjusted gross to gross method is not a reasonable method of allocating your expenses. And what is this? Well, this is taking the ratio of your UBIT income from a particular activity over your total income from that organization to get a percentage, and then just taking that percentage of your indirect expenses and allocating it to the trader business income. They said that's not a reasonable method. However, they do intend it to publish a separate notice of proposed rulemaking to provide further guidance on expense allocation and calculating UBTI. I don't know when that's coming out, but I imagine something will come out soon. If they're going to release this new draft and this new form for 2020, they'll want to get that out so that everybody can make sure they're using a proper approved IRS method for allocating expenses. That is all I have regarding UBIT right now. And I think, Carrie, do we have a polling question after this?
Yes, we do. And I am going to move right on to that. Polling question number 5. Thank you, Jenny. What do you think about using the NAICS codes to determine UBI silos? What's a NAICS code? NAICS codes are an ideal identifier for this purpose.
Yeah, it's the North American Industry Classification System codes.
Yes. There are too darn many of them to choose from, or you have no opinion. We'll hold this open for just a moment while you have an opportunity to respond. All right, looks like our polls are in, and Claire has released our results. Let's see, 6% wonder what the codes are. No opinion there, I see. That's pretty much the universal agreement there. All right, then I will move on to speaking with you guys a little bit with regard to special events, particularly of fundraising, different types of gifts that a typical fundraising event would garner, and how we go about reporting those types of gifts on Schedule G, and also some of the differences that you will experience when you're considering this information and considering these opportunities for book versus what the tax return is going to require of you. So for today, our objective is to help you understand what makes some events more special than others, to recognize when a fundraising event has become special enough, if you will, to require Form 990 reporting, to recognize different types of gifts that are out there. They are not all the same. Understand reporting requirements for Schedule G, and there are 3 sections to Schedule G. For the purposes of this conversation today, we're going to focus on Part 2. and provide you with a few simple best practices for accounting for special events and tracking the information that you need to report. So what is a special event? A special event is a social engagement that brings together people from the organization and the community to raise awareness of a need, awareness of an organization, and support for a cause. There are, as you can imagine, any number of types of special events for nonprofits. They are limited only to the imagines of the people that can come up with them. Some that you see around your community and are probably pretty common might be a special black tie gala or a casino night. Silent auctions and live auctions are also pretty popular. Benefit concerts, sporting competitions, the golf classic or the marathon, raffles and bingos, fall festival, carnivals, bake sales. Clearly, if you can think of it, you can and make it into a special event, you have that runway to be able to do so. The idea ultimately is that your special event is going to hopefully spark, if you will, generosity in your community. You want to inspire people and get them attached and excited about your message. We're going to move on then to polling question number 6. Not-for-profit organizations use special events for what purpose? And we'll take just a moment to let that clear.
Hi all, sorry about the technical difficulties. We're still having a couple of issues. We're working to fix those as quickly as we can. I do apologize for the inconvenience. One of the downsides of not being able to get together in person this year is that we aren't able to, you can sometimes run into these technical challenges. We'll go back down to where we were. It really draws back to what Amy had mentioned earlier about preparing for disruption. As you can see, that even applies to sometimes trying to run webinars in a COVID-19 world. And so while we're trying to get Jenny and here. And here is Jenny, and she will take over from this point. Apologies again for the disruption.
Hi, everybody. Sorry for this. My screen locked up as well. So Carrie was talking about special events and what's included in a special event, or what is. To be a special event, it has to be unique. It can't be something that's carried on regularly. And most organizations generally have like a yearly gala or yearly event that they do. And as long as you're not doing it all the time, then it's considered a special event. The special event is an activity that's undertaken to induce potential donors to contribute money, security, service, or anything else to the organization. So again, doesn't include things that you regularly carry on, doesn't include activities that are substantially related to the accomplishment of your organization's exempt purpose. Solicitation campaigns that generally only generate contributions are not considered special events, as well as gaming. Next one.
Just click that screen.
But what types of gifts do we have when we have a special event? A lot of times people will buy tickets for cash or give cash, buy tickets to a thing, whatever. They also contribute gifts in kind to special events, such as household goods and clothing, vehicles, and you see the whole list here. But when you're reporting the gifts in kinds, and usually this comes up when people have auctions and that kind of thing, they donate something to the special event. So gifts in kinds, furniture, equipment, clothing, supplies, any kind of tangible items that will be sold, materials, collectible items, these are treated the same way for tax purposes as GAAP, just like GAAP. We're going to put them as a non-cash contribution, and it's part of revenue. Contribution for the use of items to be sold at a fundraiser or advertising and other services are going to be excluded from income and the expense on the tax return. I'm not sure on the audit side whether they actually come up with a dollar value or a donation value, but for tax purposes, you're not going to include these on your 990. Okay, now we're coming up with a polling question number 7, true or false. All gifts in kind are always treated the same way for GAAP and tax reporting purposes. Going to take a few minutes, and then Claire will let us know the answers. Okay, so the response to the polling question is that 94% say false, that they're not always treated the same. And that is correct. So is there another slide? I think. Okay, reporting on Schedule G. For the 990, you're going to report your Schedule G and your statement of revenue. You're going to have your fundraising expenses listed down there, and they're going to be netted with expenses. The gross amount is going to be netted with expenses. However, if you do have contributions that are over and above the cost of the fundraising ticket or whatever, those are actually going to be pulled out and put under as contribution revenue on line 1. So when you're on part 4, lines 17 to 19, they're the questions that ask about your fundraising events. And you answer yes on line 17 if the total amount reported for professional fundraising services in part 9 exceeds 15,000, and then you're going to have to go to and complete Schedule G. If you answer yes to the organization generated more than 15,000 total of fundraising gross income and contributions, you're also going to go to Schedule G, Part 2. And if you answer yes on line 9, if the organization reported more than 15,000 in gross income from gaming activities, then you're going to go to Schedule G and complete Part 3. So while you put this information on the statement of revenue, it will require you to fill out Schedule G and give more detailed information about your fundraising activities. All right, she's got a case here. We have fundraising income. We have fundraising event for tax. We have ticket sales of 10,000, sponsorships for 50,000, raffle and auctions of 20 for a total fundraising of 80,000. Direct fundraising expenses of 20, so the fundraising event netted 60,000. So for fundraising for tax purposes over on the other side, of the 10,000, we have ticket sales and tickets of 4 and 6. We have sponsorship donations of 48 and sponsorship quid pro quo of 2. We have proceeds from the auction 9,000, proceeds from the auction in excess of the fair market value of 1,000, and then raffle tickets and gaming. So let me see, total book fundraising income of 80,000 for tax purposes. We're going to have 90,000. We're going to include fundraising expenses of fundraising expenses of 17 and 3, and then for net fundraising event of 60. And for tax purposes, we're just going to kind of show it a different way. We're going to end up with net fundraising of 60,000. So what you do is you identify the items that were donated for the auction and the raffle. You split the revenue between the ticket revenue between quid pro quo and the donation treatment. Quantify the portion of your sponsorship revenue, and then identify the auction sales in excess of fair market value, and then you split your expenses between your fundraising and your gaming. So when you come over here and you fill out your Schedule G, you're going to show you have 80,000 in receipts, and then you had contributions that were direct contributions of 63,000. So you end up with gross revenue from the fundraising event of 17, and then you're going to reduce it by your actual expenses to come up with your net fundraising income. And over, I'm sorry, I should have gone on the left side first, but she's split her revenue coming in between contributions and what was actually something from the sale of a ticket from the fundraising. She pulls out the donations from sponsorships versus one that were actually going to the fundraising event, the auction proceeds. And then you totally pull out your gaming because that is separately filed. It's not part of the fundraising. That's a separate line item on your statement of revenue. So best practices. Be alert to fundraising activities that may fall into the special event category. It's not a part of your regular everyday activities, and you're having the fundraiser to induce people to contribute money to your organization. And once you've identified as a special event, maintain your detailed records, because what you need to be able to do is pull out the actual revenue and expenses that were from the fundraising event and report those, and any other income that you have over and above the ticket sale or whatever it is that you sold is actually just shown as a contribution for tax purposes. And then you want to keep your expenses that were directly and indirectly related to producing the event. And so you also want to make sure that you're tracked, if you have more than one fundraising event, that you actually track the income expenses by event so that you can report these separately on your Schedule G. And now we have another polling question, number 8. How has COVID-19 affected your organization's special events in 2020? Whoops.
Claire, can you go ahead and launch that poll?
I'll give everybody a few minutes to answer the question. Okay. All right, are we ready? We can get the results of this poll, and it looks like that everybody is hoping for have better luck in 2021. Most events have been canceled. And now I'm going to take it back to Richard and let him say a few more words.
Okay, thank you, Jenny. appreciate everyone tuning in today, and I certainly apologize for the technical difficulties in the second part here. I certainly want to give a special thanks to Jenny Belcher. You can see her there on the screen, who did quite a bit more of the presentation than she had originally intended, and she did a great job stepping in. So thank you, Jenny, so much for doing that for us. So again, thank you all for attending. We do plan to circulate the PowerPoint, and the recording will be sent out. It'll be coming out via Eventbrite along with the CPE certificates. Again, just to reiterate, those certificates should be available within 2 business weeks. And again, coming out via Eventbrite. So if you have any additional questions about the topics covered today, please feel free to reach out to any of the presenters. So from the first half or the individuals on your screen, we'd be happy to entertain those questions and try to make sure that we get you the best answers possible. So again, thanks everyone for attending. I hope you all have a great weekend and a happy holiday season.